I welcome you to today's Global Macro with the King of Waves. Today is 17th of February 2026, and like our usual practice, we want to look at the forex market together. And the focus of our coming together on weekly basis is so that we can analyze the market together from the global macro perspective, so that we can pinpoint assets that we can focus on for the week. And that's how we do, and that's how we do our analysis at Potential Miners International. And we are hoping that as many people that will be connected to this weekly analysis, they are going to benefit a lot, in that they will be able to identify assets to trade from a valid fundamental and sentiment perspective. And that is what is important, and that's how professional players in the forex market, they approach the market. So today, like our usual practice, we are still going to dive deep into what the market holds for us. We are going to look at the fundamental standpoint, narrow down to the interest rate divergence. We are going to look at the sentiment overview of the market at a global level. Then we are going to look at some technical. Then we'll pick some assets so that we can project. Then, of course, we'll expect that in the course of the week, we'll have a very profitable trading experience. I remain Mr. Akimbode Damilola, the King of Waves, and of course, I will be hosting you on today's discussion. Let's quickly dive into what we have. Like if you have been following us, you know that the first thing we want to do is to look at the fundamental standpoint. This is very important, and whatever the market is doing at any point in time, don't be carried away. Forex market is a game of interest rates. Let me repeat that. Forex market is a game of interest rate, and you really want to pay close attention to what the interest rate is, especially for the 8 major currencies that an ideal forex trader should take note of, and that include the Australian dollar. I'm going to quickly say them, and I'm going to identify their interest rate. And of course, like you can see on the screen, you can see my screen. The 8 majors include the Australian dollar with 3.85%, the GBP, Great British Pound, with 3.75, United States dollars with 3.75% interest rate, Canadian dollar with 2.25%, New Zealand dollar with 2.25, Euro with 2.15, Japanese yen with 0.75, and franc with 0.00%. Now, the interest of our fundamental overview of the 8 major is to look at currencies that has pairs of currencies with a very wide interest rate divergence. And you will notice that if you pair AUD with JPY, the divergence in the interest rate is very wide, and of course wider than when you pair Euro with JPY. And our focus is to say, at the fundamental level, let us identify assets with a very high interest rate. Then let's identify assets or currencies with a very low interest rate. Then this will now form our short listing of assets or short listing of currency pair, which of course, by the time we now get to the next analysis, which I call the optimization phase, where we do the sentiment overview of the market, we will now optimize this list or choice of a currency pair. So, but on the fundamental standpoint, to start with, it's obvious that if you pair AUD with JPY, the divergence is very wide. If you pair GBP with JPY, the divergence is also very wide. And also, if you pair United States dollars with JPY, the divergence is also very wide. So on that standpoint, if we have opportunity to pick trades on JPY, we want to be looking at picking JPY and pairing it with assets that or currencies with a very high interest rate. And of course, you can also pair other currencies depending on the divergence. But why you really need to start from this standpoint is because bulk of the time, especially when we have a pure risk on narrative of the sentiment of the market, investors they engage in carry trade, and carry trade is when they borrow money from a very low currency or country with a very low interest rate. They now engage in transactions or investment transaction in a country with a very high interest rate. Don't forget, when we say Australian dollar, we are saying the economy of the Australia. When we say United States dollars has interest rate of 3.75, what we are saying in essence is that the interest rate for United States as a country as of today, 17th of February 2026, is 3.75. And that is very important. And that is one of the reasons why trading in the forex market is not a business of or some miscreants or some young people that really want to just gamble their way into success. This is a very classic and is a global market where big boys play in. And as much as you can lay hold on a particular framework of analysis that is stable and is tested over time, you can play in this market for a long time, and that's the essence. We are hoping that Potential Miners International is going to contribute to the forex community by building people that will view the market from a long-term perspective. You view the market from investment perspective, not from this gambling or flipping money perspective. And that is why we are taking our time to look at the fundamental standpoint. Note that when we say fundamental, we have other indicators that sum up to now come about the interest rate decision of any economy. But because we want the analysis to be very easy for an average person to approach, and we know from a theoretical and operational standpoint that bulk of the indicators, they are indicators that monetary policy makers will look into before they can decide on the level of interest rate, whether they want to hike it, they want to hold it, or they want to cut the interest rate. And of course, because interest rate now happen to be in the center of the value of an average currency, we now narrow down our fundamental analysis, especially when we come together like this, to say that you want to look at the interest rate and you want to be conscious of the divergence of interest rates when you begin to compare or pair currencies. So having said all of that, we want to go straight into the sentiment storyline. This is very important. You don't want to just look at the interest rate or any fundamental indicator and you want to take decision. You want to now look at what is the tone of risk, risk in the market on a global level. And to do that at Potential Miners International, usually we have indices that we use, and these indices help us to gauge at any point in time what is the summary of the narrative of risk in the market, especially from the standpoint of investors on a global level. So where we start our sentiment analysis with looking at some of the stock market indices, and we start with the S&P 500. The narrative behind this is that when the S&P 500 is maintaining a bullish structure, that means that investors they are still optimistic about the standpoint of movement of capital in the global market, and they are rest assured that their money is not going to be exposed to a risk that can damage their projected or expected return for the year. So when the stock market, as represented by S&P 500, is on a bullish market structure, bullish market structure in this sense that especially on the daily, you have the market, above the cloud. We use this gauge. This is PMI centered now. We use this gauge to look at what is the tide of the stock market. Once the S&P 500 in this case now is above the cloud, is a confirmation that we have a risk on in the market, which means investors, they are not panicking at this moment to a reasonable level or to an high degree. So having seen this, we can say that okay, there is a risk on in the market. But because we want our analysis to have different validations here and there, so that we can be rest assured that we are not going to be taking wrong decision when it comes to the risk stance of the market, we use other stock market indices too to gauge the risk aversion level or the risk sentiment of the market. So after the S&P 500, we also consider the Nasdaq Composite Index. And when we now get to this level now, for today, 17th of February 2026, the Nasdaq Composite Index is giving us indication that there is likelihood that investors, they have a level of concern when it comes to risk stance of the global market. And you can see that because the index is now trading below the cloud, this particular tide cloud, for the Nasdaq Composite Index. But because we don't want to confuse ourselves, we ensure that we have at least 3 stock market related index. Then we'll now have what we call the panic or fear index with the dollar index. And in total, we have 5 indices that we look at before we can conclude on the risk narrative or risk sentiment narrative of the global market. So we want to move into the Dow Jones Industrial Average Index, and the expectation is that if we have S&P 500, we have Nasdaq Composite Index and Dow Jones Composite Index. If we have 2 of these particular indices telling us the same thing, then we are going to go with them. Whatever indices that is giving or index that is giving us a contrary overview is just going to serve like an hint for us. Note that all these indices, they are communicating information at any point in time. However, because we needed to come out with a conclusion about the risk overview of the market, we want to look at 3 of these stock market related indices. Then having said that, or having seen these 3, we will now conclude, are we sure that we still have risk on narrative in the market? So we look at the S&P, is above the cloud, is predominantly bullish. We look at the Nasdaq is giving us indication of a risk off in the market. But when we look at the Dow Jones now still confirm that there is still predominance or the predominance of risk on template or risk on overview in the market. So we are going to go with that. But before we go that, we take our decision, or we conclude on our decision, we want to look at the fear index, or what we call the volatility index of the S&P 500. And this, we are expected to have this like to double check what we are overviewing from the stock market standpoint. So this index or this volatility index is showing us the level of panic or fear in the market. Now the threshold or the benchmark is 20. When this index is showing us value that is below 20, is confirming that there is a level of stability in the market, that investors, they are not concerned about any particular policy that is coming up, and is not deciding whether they want to move their capital away from safe haven or from high yield into safe haven, as the case may be. So having overviewed this particular VIX now, we notice that we have the VIX around 20.94. Fathers, at this morning, it rose to as high as 22.42. That's to tell you that what the Nasdaq Composite Index is telling us is not totally wrong. However, sometimes we have transition period. So you don't want to jump into conclusion to say that because the VIX is above 20 immediately, we are in a risk off. Before you can confirm that we are in a risk off, two of the stock market indices must be below the cloud. In other words, two of the stock market indices must show you a predominant bearish market structure. And we are yet to have that now, because from what we have seen, we saw that the Nasdaq, the S&P 500 is showing above the cloud, is trading above the cloud, I beg your pardon, while the Nasdaq is trading below the cloud, but the Dow Jones is still trading above the cloud. So from this standpoint, and we look at the VIX now, the VIX is still around 20, which means that anything can still happen. When you have the VIX below 20, apparently, it means that there is now double confirmation of risk on in the market. Now, before we now conclude on what is the standpoint of the market as of today, 17th of February 2026, we need to look at what the dollar is doing. And like we used to say, the dollar is the king of the forex market, and you don't want to shy away from that. So you want to really take note of what the dollar is doing. And for you to know what the dollar is doing on an aggregate level, you want to look at the dollar index. Dollar index is when dollar is paired against the major currencies of the world. So when the major currencies of the world, you compare, you consider it as a basket of currency, and you relate it with the dollar, that is when you have dollar index. The index that you generate is what you call dollar index. Now, if the dollar index is selling predominantly, it means that all over the world there is a predominant level of dollar dumping, which means that the value of dollar is falling relative to the basket of other currencies of the world. And that is what the narrative that the dollar index is telling us at any point in time. So because we have this gauge now that we use at Potential Miners International, our conclusion is always be in favor of dollar aversion when the dollar index is below the cloud. I want to believe that you can see my chart clearly. When the dollar index is below the cloud, the conclusion is that there is still predominant level of dollar dumping. Whatever movement that the dollar is doing, in as much as it's below the cloud, we conclude that there is still a predominant level of sell American narrative in the global market. Remember, anything can happen in the global market at any point in time, but whatever will happen, as long as this dollar index is still below the cloud, is still showing us that there is dollar aversion. So in summary, what is the narrative of the market based on our overview? From the stock market, we notice that we still have predominant bullish structure on the S&P 500 and the Dow Jones Industrial Average. Even when the Nasdaq Composite Index is showing us, a yellow light, we can still not conclude that we have risk off yet. So in essence, we have risk on. But the dollar now is now telling us that there is still a predominant level of dollar dumping, which means by the time you relate that with risk on, the conclusion of the market will now be that we have a risk on dollar aversion. And this is the template that we'll now use to optimize the choice of asset that we have selected during our fundamental analysis. Then we can now go and select those assets and do a bit of technical analysis. So today I'm going to probably select two assets, just so that this video is not going to be too long. We have always advised that if you want to trade with us at Potential Miners International, we always leave the link to the Telegram in the description of our videos. And the essence of this is so that we can build community of traders that we learn how to approach the market from a professional standpoint and build a mind to stay in the market for a long time. For us at Potential Miners International, this is like a lifelong journey for us, and of course we are not rushing anywhere. That is why we take our time. This that we are discussing is a product of over 6 years of research, and we took our time to look at it, to see what the big players are doing, to look at what the retail traders are doing, to look at every part of the industry, and we have come up with this approach of the market. And we believe that when you apply this approach and you are confident with this system, you are not going to lose your money in the forex market. Take that from me. But having said that, let's just overview one or two assets. Usually we start our analysis with the gold. We start our analysis with gold, and of course anytime you pick any asset, you want to remind yourself what is the narrative or the conclusion of the market narrative when it comes to sentiment overview. The one we have just done, we notice that we have risk on dollar aversion. So if that is the narrative of the market, it means that from the sentiment standpoint, because gold is paired against the US dollars, we are still expecting a push up on the gold. And that is the predominant expectation of, at Potential Miners International. Then what we do is we look at what is the directional bias, and we do that on our weekly chart. The directional bias is still a buy. Let's look at the structure and tide. As of today, we are still seeing that the tide is a buy. We are only waiting for the structure to align with the tide. What that means is that we expect that this particular price or gold is going to break above. We are expecting that if gold is going to buy like we are expecting it, it should break above 190, above 5,120. If gold can break above this place, then we'll be looking for a buy position. This is a bullish. Let's say maybe this is a change of character or break of structure, whichever one. We are expecting that gold should break above. Last week I said gold should break above 5,100. It touched that place, but it could not break above it. And because it did not break above, we are not projecting to take any trade on gold. So we are expecting that gold is going to buy. Predominantly, that's our expectation based on our fundamental and optimized sentiment analysis. Now, all other things held constant, before we begin to look out for a position on gold, we have confirmed that the directional bias is still a buy. The tide is still a buy. The tide means that the price is trading above the cloud, above this cloud, I beg your pardon. But the structure is yet to be confirmed to be bullish. So we are expecting that gold should break above 5,120. If that happens, it's going to confirm the structure of gold in favor of buy. Then we can now position for a buy. And that's our projection on gold. So as of today, we are not going to be doing anything on gold. We are not going to be selling. We are not going to be buying yet. We will only buy until when gold breaks above 5,120. Take note of that. It's very important. If you don't want to burn your fingers in the forex market, just view this market as if you are a big bank. When you want to enter a trade, ask yourself, if this trade happens to be 100 million US dollars, am I going to trade it like this? If this trade I'm about to enter, the one you are trading with maybe $10, maybe $50, or maybe $500, if that trade happens to be 100 million US dollars, will you still enter the trade? That is how you can begin to structure your mind so that you begin to view the market from a professional standpoint. So let's just overview one more asset before I call it a day, because I don't want this video to be very long. We looked at Euro USD last week, And our expectation last week is that we are expecting that we are still going, Euro USD is still going to push up. Unfortunately, we entered trade on this Euro USD and it stopped us out. It's obvious that Euro USD is just playing around. But then by the time we overview the sentiment of the market and we look at the directional bias, we still maintain that we are expecting a push up on Euro USD. We are expecting what? A push up on Euro USD. In fact, we are expecting a push up to somewhere around this place. I think I said this last week. We are expecting a push up to somewhere around 1.2214, something around that place. That is an expectation based on our global macro analysis. We have seen that we have risk on dollar aversion predominantly now. At the moment, the dollar might be gaining strength. It doesn't mean that we now have pure risk on. Dollar aversion is still the template of the market as of today, 17th of February 2026. You need to take note of that. However, the condition to enter on Euro USD has not matured yet. We only have our directional bias still intact because the market is trading and showing us, a directional bias in favor of buy on the weekly. When we get to the daily, the tide is still in favor of buy. And the structure is still hovering between, if this particular candle, I want you to pay close attention. If this particular candle breaks here and it creates a change of character around this place, if it creates a change of character around this place, then the likelihood that Euro USD might break below this is very high. However, because we are expecting a buy, we will stay put. The only time we'll be looking for a condition to enter the market is when now on the daily we have the structure to be a buy, the tide is a buy. But when you get to 4 hours, so this is where we are looking at now. When you get to the 4 hours, the structure is a sell, the tide is a sell. You get that now? So before we can enter a trade on Euro USD, we are expecting that Euro USD is going to move to the upside and close above this place. Take note of this. And when it does that, it's going to give us a bullish break of structure. When it gives us a bullish break of structure, that is a confirmation that the structure is now in favor of buy. However, that particular impulse move must close above the cloud. Then we can now be looking for a buy on Euro USD. You see that now? This is how you can just position in the market and relax yourself. When trade conditions are not met, just allow the market to be doing its thing. It's not going to make sense for you to blow your money, when trade conditions are not met because you are just looking for one trade to trade. Just stay put, let the market define its direction. So we are expecting a buy on Euro USD for the week between now and next week. If the market decides to give us the buy, we are going to enter it. You see it now. So that's how to position for trade opportunity in the market and not get your fingers burnt. I want you to really pay close attention to everything that we have been discussing on this channel. The essence of our coming out is to build a new narrative about the forex market, building community of professional forex trader, people that can retire and say I want to trade forex, people that can take forex trading as their, not as their side hustle, but as their major source of income. Why? Because they have been able to hit a level of consistency in the market, and that is possible. We have leveraged on the strength of research, and it took us over 6 years to come up with something that is presentable. And that is why we are confident that if you apply what we tell you, number one, you are not going to lose your money in the forex market. and you will now be able to establish a consistent, pattern of income generation from the forex market. And till I see you in the next video, I really want you to trade with caution. If possible, if you know you don't understand some of these things and you really want us to, shed more light on it, you might need to reach out to us, maybe on the comment section, to say I really want to know more. Then we will just pick it from there and begin to show you. And of course, the essence is not to take money from anybody. Obviously, if there is money in the market, the money is not in the hand of anybody that is still struggling to trade the forex market. But we might need to just tell you to do one or two things so that you can, pay the price required for our attention at the platform level. Then we'll now begin to show you, how we do our things. Or you can just join the Telegram channel. That way you don't need to pay anything, you don't need to be charged anything. Just join the Telegram channel. When we see any trade opportunity, we are going to post it. Then of course you can watch all our YouTube video. It's free, and you begin to learn from there. Is that simple. And we expect that, over time we want to build people that will be confident about the forex market, and they can train their younger ones, train their children and their children's children on how to approach the forex market. Until I see you in the next video, I remain Mr. Akimbode, the King of Waves. Thanks for listening. God bless you.